Over the last few years, there's understandably been a lot of attention paid to the big economic picture: inflation, interest rates, and the ballooning government debt. It's a complicated situation, and for most people, the more immediate consideration is how it all affects their own bank account. You work hard, but it feels like you're just about keeping your head above water as the cost of everything seems to be on a relentless climb. This isn't just a feeling. It's a reality reflected in the numbers, but that doesn't mean you're powerless. So, how do you actually get a handle on your finances when things are so uncertain? What are the strategic moves you can make to build a buffer against economic shocks? And finally, if money's tight, how do you deal with things like debt or even think about investing? All right, the first move is to figure out where your money is actually going. I know the word budget can sound incredibly restrictive, but it's better to think of it as a tool for understanding your cash flow. It's not about restriction, it's about having accurate data so you can tell your money where to go instead of wondering where it all went. The first step is simply to track your spending. For one full month, log every single dollar that leaves your account. You might be surprised by what the data shows you. The daily coffees, the multiple streaming subscriptions, the impulse buys, it all adds up. The point here isn't to judge yourself, it's to get a clear picture of your financial habits. Once you have that data, you can separate your needs from your wants. Needs are the non-negotiables: housing, utilities, food, transport. Wants are everything else. The goal is to ensure your needs are covered first, and then you can intentionally allocate funds to your wants and, crucially, your savings goals. A decent method here is the zero-based budget, where every dollar of income is assigned a job, whether that's paying a bill, going into savings, or being spent. Your income minus all your expenses should equal zero. It forces you to be intentional. The second move is to build an emergency fund. This is your personal safety net that sits between you and an unexpected event. An emergency fund is what prevents a sudden car repair or a medical bill from turning into a full-blown financial crisis that pushes you into high-interest debt. So how big does this fund need to be? The standard advice is to have 3 to 6 months' worth of essential living expenses set aside. This would cover your rent or mortgage, utilities, groceries, and minimum debt payments. Now, that figure can seem daunting, especially when savings feel tight. Don't let the final number put you off starting. Your first goal should just be a starter fund of around $1,000. That amount alone is often enough to absorb many of life's smaller financial shocks. But anyway, the key to getting there is to make it automatic. Set up an automatic transfer from your checking to a separate savings account every payday. This pay-yourself-first approach removes the need for discipline. And put that money somewhere sensible, like a high-yield savings account where it can at least try to keep up with inflation instead of a checking account earning nothing. This isn't just about money, it's about reducing future stress. All right, for our third move, we need to talk about debt. In uncertain economic times, when interest rates are high, carrying debt, especially high-interest debt, becomes a significant drag on your finances. Dealing with it is about freeing up your most powerful wealth-building tool, your income. First, not all debt is the same. The credit card charging you 22% is a financial problem. A low-interest mortgage is a different category altogether. The priority should always be to tackle high-interest debt first. There are two main schools of thought on this, the avalanche method and the snowball method. With the avalanche method, you focus extra payments on the debt with the highest interest rate while making minimum payments on the rest. Mathematically, this saves you the most money. The snowball method, on the other hand, focuses on behavior. You put your extra payments toward the smallest balance first. Once it's gone, you roll that payment on to the next smallest. The psychological boost from clearing a debt can provide powerful motivation. Whichever one you choose, consistency is what matters. If you're feeling overwhelmed, it can also be worth calling your creditors. Many are willing to discuss payment terms or hardship programs, but you have to be the one to initiate the conversation. Our fourth move might feel like the last thing you should be doing when money is tight, but we need to discuss investing. When markets are down and the news is negative, the natural instinct is to avoid risk. But history has consistently shown that periods of economic uncertainty have also been some of the best times for long-term investors. Except that's not exactly true. It's more that it's one of the only reliable ways to have your money outpace inflation over the long run. You don't need a lot of capital to begin. The key is consistency, not trying to time the market. Start with a small, regular amount, even $50 a month, and automate it. This is a strategy known as dollar-cost averaging, and it smooths out your purchase price over time. For most people, especially in uncertain times, diversification is critical. Instead of trying to pick individual stocks, it's generally wiser to consider low-cost index funds or ETFs. These products hold a basket of stocks, like the entire S&P 500, which automatically spreads your risk. In a downturn, it's also common to see more stability in defensive sectors, industries that provide things people need regardless of the economy, like healthcare, utilities, and consumer staples. But anyway, the main point is that investing is a long-term strategy. Making emotional decisions based on short-term market movements is rarely a winning formula. Big disclaimer time, as always. It's probably a good time for a big disclaimer. I am not a financial advisor, and this is not financial advice. This is for informational purposes only. These are just frameworks for thinking about money that have proven useful. You should always do your own research, and maybe even consult with a professional who understands your specific situation. For our fifth and final move, we're looking at how to optimize your regular spending to free up cash. This is about making tactical choices that can have a surprisingly large impact over the course of a year. Start with your regular shopping. Making a list and sticking to it, using coupons, and opting for store brands, which are often made in the same factories as name brands, can cut down costs significantly. Cooking at home more often is another obvious but effective way to reduce spending on expensive takeout. Then run an audit of all your subscriptions and automatic payments. That gym membership you don't use, the streaming service you forgot about, these are just cash leaks. Cancel anything that isn't providing real value. Then look at your larger recurring bills. A few calls to shop around for better rates on car insurance or your cell phone plan can often lead to significant savings. Companies would rather give you a better deal than lose you as a customer, but they won't offer unless you ask. So we've covered 5 moves to help manage your finances in a tricky economy. Understanding your cash flow with a budget, building a buffer with an emergency fund, strategically tackling debt, continuing to invest for the long term, and optimizing your spending. The common thread here is moving from a reactive to a proactive position with your money. Financial anxiety often comes from a feeling of powerlessness against larger economic forces. These steps are about focusing on what you can actually control. This isn't about getting everything perfect overnight. It's about making small, consistent progress. Every dollar saved and every bit of debt paid off is a step towards a more resilient financial future, no matter what the broader economy is doing. I'm curious to hear what you think. Leave a comment below with the one area you're focused on right now. Is it cutting spending, paying down debt, or something else entirely? And if you found this video useful and want more analysis on how to manage your money in a complex world, make sure to subscribe and turn on notifications so you don't miss the next one. Thanks for watching, mate. Bye.